In 1720, a company with no real business drove Britain insane with greed and speculation. You feel the absurdity immediately because the headlines promised fortunes that never existed. The opening months of that year felt like every dream of easy wealth converging into a single frantic market. You will meet merchants, ministers, and ordinary people all swept into a mania that rewired their lives overnight. What happened next will shock you, because the South Sea Company was less a machine for trade than a machine for creating belief. But here is where it gets interesting, because the belief itself became the asset everyone traded. You need to understand where the storm began, and that starts with the South Sea Company's origin story. The company was granted a monopoly on trade to South America, which in practice included the horrendous business of trafficking enslaved people across the Atlantic. Many investors chose to ignore those moral horrors because the promise of exotic profits was an easier story to sell than the brutal reality behind it. You will also learn that the company was not simply a trader, but a financial parasite that fed on government debt. The famous debt for equity scheme transformed national liabilities into tradable shares and turned political power into private fortune. What happened next will make you realize how modern finance can be shaped by a few privileged insiders. You should see the clever arithmetic behind the scheme because numbers seduced the establishment into complicity. The government offered to exchange large chunks of its national debt for South Sea Company shares, a transaction that promised to simplify accounts and reduce interest payments. The arrangement sounded like bookkeeping magic, a clever fiscal maneuver that would bring stability to public finances while enriching chosen private investors. You will soon understand that the deal also centralized enormous speculative power in the hands of the company's directors. Their ability to manage public debt was essentially a license to manipulate prices and allocate national resources. But here's where it gets interesting, because the mechanics of the swap created incentives for deception and rapid inflation of the share price. You will meet the architects and beneficiaries of the scheme as you follow the money through political corridors. Members of parliament and high officials received stock allocations and secret payments disguised as investments and rewards. These gifts functioned as bribes that ensured favorable legislation and public silence, while share prices climbed to irrational heights. You will notice how easy it was for insiders to turn public office into private profit because governance systems lacked transparency and accountability. The directors cultivated relationships at the highest levels until the company felt untouchable, a perception that fueled more speculation and reckless confidence. What happened next will show how a culture of corruption can become the accelerant for a full-blown financial orgy. You will watch the share price climb in a way that looks almost supernatural when plotted on a chart. Early in 1720, the company's shares traded around £128, and in the space of months climbed past £1,000 per share. The velocity and scale of that rise would shame many modern bubbles, and it was driven partly by a limited supply of shares that insiders carefully rationed to create a frenzy. You will start to see how simple scarcity, storytelling, and manufactured demand can create price explosions with little underlying economic justification. People were convinced that the future profits from trade with the New World justified insane prices, even when the company had few ships and uncertain trade rights. What happened next will show how the narrative of inevitability became more valuable than the business itself. You will enter the feverish coffee houses of London, where the bubble lived and breathed in human mouths. These were the social networks of the age, the places where rumors metastasized into investment decisions and sheets of speculative pricing were debatedly. Coffeehouse chatter functioned like modern social media, amplifying gossip and rumor into coordinated mass behavior that propelled the market higher. You will also discover a strange legislative feedback loop in the form of the Bubble Act, which ironically encouraged even more speculative formations. The law was meant to restrain corporate charters, but instead enabled a proliferation of ad hoc joint stock companies that capitalized on the speculative mood. But here's where it gets interesting, because legal attempts to control the mania only spread it further and legitimized wild new ventures. You should understand how manipulation worked in practice because the tactics were both brilliant and petty. Directors circulated optimistic newsletters, hosted lavish subscription parties, and selectively released financial information to favored investors. They also organized staged share subscriptions and false accounting practices to create an illusion of growing demand and solvency. You will notice how these techniques mirror modern pump and dump strategies despite the centuries between them. The company created artificial scarcity, rationed allotments, and rewarded loyal backers with early access, all while selling narratives of imminent colonial riches. What happened next will reveal how these manipulations eventually collided with reality and tore the illusion apart. You will read about the specific bribes and gifts that greased the wheels of power and inflated the market further. High-ranking officials took stock allocations that did not require upfront payment, creating a hidden transfer of value that tied their fortunes to the company's success. These secret arrangements made the company feel endorsed by the state, which further convinced ordinary investors that the shares were safe and sanctioned. You will realize that corruption was normalized because it was woven into the very structure of the deal and the incentives it created. When political survival depends on financial gain, regulation becomes theater and ethics become negotiable. What happened next will push the mania into an even more dangerous social terrain where entire communities speculated with borrowed money. You will hear about trades that changed ordinary lives and wrecked families because speculative fever spared no class. Artisans, clerks, widows, and servants mortgaged future earnings and property to buy into the bubble at its peak. In taverns and on doorsteps, the new investor class displayed the same bravado as the elite, convinced that the market would keep rising indefinitely. You will visualize letters and petitions filled with hope and later with despair, because the human cost of the bubble was real and immense. Entire savings were turned into worthless paper in a matter of days, leaving people destitute and desperate. What happened next will show how quickly confidence unraveled, and how panic spread through the same social networks that had created the frenzy. You should picture the climax, because the peak of mania was almost theatrical in its absurdity and exuberance. The share price reached dizzying heights, and public celebrations accompanied each new rise in price, as if the market itself were a form of national entertainment. Tellers and street criers shouted about fortunes being made overnight, while elegant salons debated investment strategies like theological doctrines. You will sense how this performative optimism created self-reinforcing expectations that made selling feel like sacrilege. To cash out was to betray the communal dream, and so even cautious investors stayed in longer than they logically should have. What happened next will shift the mood from revelry to dread when the first real doubts began to appear in public discourse. You will encounter Isaac Newton in the middle of this storm and notice the irony of his involvement in such irrationality. Newton famously calculated the laws of motion and light, and yet he invested heavily and ostentatiously in South Sea shares without seeing the mania's danger. His later regret, expressed in private, would become one of the most quoted comments about speculative madness in financial history. You will read his reported line about thinking he could calculate the motions of the heavenly bodies, but not the madness of people. That famous regret captures the uncanny power of social contagion to overwhelm even the most rational minds. What happened next will trace the reversal of fortune that humbled geniuses and ruinous speculators alike. You will witness the first cracks appearing when confidence faltered and liquidity dried up abruptly in fragmented corners. Rumors of insider sales and dubious accounting began to circulate in the same coffee houses that had once amplified optimism. As a result, some investors tried to sell and found there were no buyers willing to take the paper at the inflated prices. You will see how panic can be triggered by the smallest catalysts when expectations are precarious and leverage is high. The company's inability to deliver real profit streams made the stock suddenly vulnerable to crowd psychology. What happened next will accelerate rapidly as a cascade of selling turned a correction into a catastrophic collapse. You will read about the speed of the collapse because weeks of euphoria were followed by days of ruin and despair. The share price plummeted from stratospheric levels back toward reality, wiping out fortunes in a matter of trading sessions. Investors who had borrowed heavily faced margin calls they could not meet and were forced into fire sales that accelerated the decline. You will learn that the social consequences were brutal, with bankruptcies, ruined reputations, and even suicides appearing in the newspapers. The psychology of loss multiplied the financial damage because people reacted emotionally and irrationally when faced with rapid decline. What happened next will show how the state responded to an unraveling that threatened political stability and public order. You will examine the government inquiry that followed because political survival demanded an explanation and scapegoats. Parliament launched investigations that revealed a trail of bribery, falsified accounts, and corrupt insiders who had profited enormously at public expense. The revelations created a scandal that shook the credibility of both the financial elite and the political class. You will find that consequences included public trials, fines, and temporary imprisonment of several leading directors and officials. The state tried to restore faith by prosecuting the worst offenders and by restructuring debt in more transparent ways. What happened next will explain how those reforms reshaped financial governance for decades to come. You will consider the economic aftermath because a stock market implosion did not stay confined to private portfolios. Credit tightened, banks felt strain from non-performing loans, and commerce slowed as confidence evaporated in touch with public finances. The ripple effects of lost capital and shaken trust harmed industries that had nothing to do with the company's original trade ambitions. You will notice that the government's finances were impaired and that the national mood turned suspicious of speculative enterprise for years afterward. Markets also experienced a long period of retrenchment and tighter scrutiny that changed how companies sought charters and how investors evaluated risk. What happened next will examine the lasting legislative and social consequences that emerged from the wreckage. You will learn about the Bubble Act as both a symptom and a reaction to the mania that had occurred. The law attempted to restrict new joint stock companies from forming without a royal charter, and was pitched as a means to protect the public from fraud. In practice, the Act centralized corporate permissions and punished innovative financial experiments while also legitimizing a narrow set of privileged charters. You will understand that, intentioned regulation can sometimes entrench privilege and create unintended consequences in markets. The Bubble Act would remain on the statute books for decades and shape entrepreneurial behavior long after the immediate crisis subsided. What happened next will reveal how the memory of 1720 influenced later reformers and the evolution of modern corporate law. You will meet individuals whose lives were wrecked to bring gravity to the statistics of ruin and loss. There were tradespeople who sold tools and houses to buy shares, young clerks who gambled their inheritances, and widows left without means after trusting confident brokers. Their letters and petitions provide a human ledger of sorrow that numbers alone can never fully convey. You will feel the scale of personal destruction because these stories show how speculative mania tears at social fabric and family bonds. Victims demanded justice and reparations, while the public mourned a loss of moral compass in finance. What happened next will ask whether history has truly learned the lessons encoded in those tragedies. You will draw striking parallels between 1720 and modern bubbles because human psychology has not changed as much as technology. The mechanics of leverage, narrative dominance, and social amplification are identical, whether transmitted by coffee houses or social media. Recent phenomena, like cryptocurrency meltdowns and meme stock frenzies, follow the same patterns of exaggerated promises and rapid price discovery followed by violent corrections. You will recognize that the instruments and platforms are new, but the incentives remain the same, which explains why history keeps repeating. Comparing South Sea to GameStop or crypto reveals recurring themes: charismatic narratives, retail enthusiasm, and institutional advantage exploiting asymmetric information. What happened next will consider how recognition of these parallels might help prevent future catastrophes. You will consider psychological lessons because bubbles are social pathology as much as economic phenomena. Herd behavior confirmation bias and loss aversion combine to make rational individuals act irrationally in groups. The South Sea Mania is an archetype for how narratives about progress and destiny can override sober analysis and inflate worthless claims into national causes. You will understand that education, transparency, and restraint are necessary, but not sufficient safeguards against mania. Institutional reforms must be complemented by cultural shifts that reward skepticism and accountability over blind faith and short-term gain. What happened next will push you to reflect on the balance between innovation and regulation in open markets. You will face the philosophical twist that markets are ultimately stories we tell each other about value, and those stories can be both creative and destructive. Money measures belief, and belief is contagious, which means that economics is also a social science rooted in narrative. The South Sea Bubble shows that when stories become detached from substance, they can produce catastrophic outcomes that reverberate across society. You will appreciate that the proper role of regulation is not to kill innovation, but to ensure that stories are accountable to facts, and that risks are transparently disclosed. The past teaches that human nature will always tempt markets toward excess, and so the responsibility for tempering greed falls on institutions, culture, and individuals working together. What happened next will return you to the modern world and ask what you intend to do with this knowledge. You will get a practical takeaway because understanding the South Sea Bubble helps you recognize warning signs in your own time. Whenever narratives expand faster than underlying fundamentals, when insiders receive secret privileges, and when leverage and credit multiply, you should feel skeptical and prepared. These are pattern recognitions that apply to crypto ISOs, meme stocks, and any asset inflated by social momentum rather than production and cash flow. You will find it helpful to ask simple questions before investing. Who benefits from the story? Where is the liquidity sourced? And what happens when sentiment reverses? Applying those questions does not guarantee success, but it tilts the odds back toward reason and away from contagion. What happened next will bring this entire story home with a final reflection and a memorable closing line. You will leave this story with a deeper sense of why history keeps repeating, unless lessons are internalized and institutions adapt. The South Sea Bubble is not just an old scandal, but a template for human error repeated across centuries and technologies. It reminds you that brilliance in science or politics does not immunize anyone from the contagious madness of markets. You will consider the final mismatched image of Isaac Newton, a genius humbled by human folly, and ask yourself what arrogance in your own field might be blind to its dangers. If this gave you a new perspective, hit subscribe and share this cautionary tale with friends who trade on hope more than evidence. The bubble may have burst centuries ago, but the story reverberates through every market that values belief over substance.